Alibaba just out with its earnings this morning, beating on both the top and bottom lines. We should point out the figures that you're seeing now are in Chinese yuan rather than U.S. dollars. And joining us now to go through some of those numbers, talk about some of the other big tech names to watch is John Freeman, a vice president of equity research at CFRA. Also, Mike Santoli from CNBC, senior markets commentator, is here as well. Mike, since you're sitting here, I just wanted to ask you how much we should take away from the Alibaba numbers. Also, how we should think about the coronavirus situation in China on a relative basis.
Yeah, this is a leading case of does the past information matter that much to the stock right now? Obviously, beating on top and bottom line, the stock goes between being a China play and being a global FANG. And right now, I think it's acting a little more like a China play. You could say the fundamentals are fine. You can make the case coronavirus somehow makes their business better positioned than other physical retail. But right now, I think it's being treated as a kind of magnified play on what you think about China growth.
John, is that right? And should it be right if that's the case?
Yeah, I think that is correct. I think it definitely is, more China correlated maybe than it's ever been. I downgraded to a hold from a buy a couple of months ago just because of all of the uncertainty regarding the trade issues. So I had a feeling that was going to hit. And, the results are very impressive. Not just on the top line, but on the bottom line as well, showing that the strong inherent operating leverage that's in this business. We've kind of seen the movie before with Amazon. There are some differences, but effectively it's the same investment thesis, right?
Well, let me just ask you about that, because to me, Alibaba and Amazon are two wholly different companies, and I always find that comparison to be, in my mind, quite strange. Because I think of Alibaba as a capital-light business, much more like an eBay. They don't actually own the factory, the distribution. They don't own much of anything. I don't want to say much of anything, but they don't own that whole chain. Whereas Amazon is a capital-intensive, heavy business. No.
It's certainly more capital intensive, but the thing I focus on is the cloud. For Amazon, for example, cloud is 10% of revenue now, or 8-9% of revenue, but it's 68% of profits. And so you've got this e-commerce retail business. Yes, that's different from Amazon, but you've got inside it a growing cloud business that is growing 62% year over year for Alibaba, right? But it also levers very well and is it's getting very close to break even, and from there it's really going to be a strong contributor to EPS, much more so incrementally than the commerce. Yeah.
So that cloud business is growing exponentially, obviously inside China.
Right.
What do you think happens when they need to break out of China, or do they need to ever?
I don't think they need to for a pretty long time. Okay. But perhaps in the Pacific Rim, they can get business there. There's no doubt about that. So there are areas of expansion, but there's plenty of opportunity just inside of China, I believe.
Right. I want to circle back to Mike, but just before I go, you have a strong buy on Alphabet. Yeah. If there was one tech company to buy, that's the one?
One large cap, yes. Absolutely, yes. That's the one.
John, can I ask you one more question? You put this on a hold several months ago because of the China trade talks. Are you considering changing your rating now that the trade talks have been resolved? Obviously, you have a coronavirus there, but a lot of people speculate that will be a V-shaped recovery once coronavirus is out of the way.
You would think, but then again, coronavirus is not quite out of the way, and that's a bit of a black box for me because epidemiology is not a strong suit, so I have to kind of it's hard for me to discount that, right? Mm-hmm. However, there's on one side, coronavirus is going to help e-commerce because people shop from home, but it's going to slow the economy, maybe all the way up to a point, down to 5%. That can't help Alibaba's business overall. So I think those kind of offset, and I'm kind of back to where I started. And I'm good with my target at roughly where it is right now.
Mike, what do you think of this early morning sell-off more broadly in terms of the markets?
Obviously, you're just taking back what you got yesterday. The market got very extended, especially in the stuff that seemed like it was insulated. That chart of Amazon versus Alibaba, you look in the last couple of weeks how Amazon has gone vertical.
Yep.
That's been going on. Basically, all this money in a high liquidity, low growth situation going into these huge marquee tech stocks. So I do think that got us a bit stretched. And right now, you got the market in a position where it can't absorb the hint that the premise that coronavirus is getting better is not maybe true.
Let me ask you about that. Kim Fennebrust was on with us earlier, and he said right now he would suggest doing nothing because we just don't know anything. It's such an opaque situation. We don't actually understand anything that's happening.
I would say do nothing based on your expectations for how this plays out in terms of the virus and growth. I can't disagree with that very much.
You think that's conventional wisdom right now on the street, which is why we keep hitting new highs as of yesterday?
I think it's somewhat conventional wisdom, but there is a little bit of a hopefulness in there that says we might get, like last year, an easier central bank slate without having to go through domestic economic pain. So I do think that the street was being a little optimistic about exactly how the U.S. market can come through this. But, I don't think it's implausible, but I think that's the way investors were leaning.